In this video, I'm gonna share with you a very powerful and very simple tool that is going to help you increase your win rate, your probability of success, and also your market understanding. So stay tuned, grab your trading journal or open your notes-taking app, and let's get into it. Alright, fanatics, in today's lesson we're going to explore and also learn how to use premium and discount ranges. Now, before we jump into the technicals, I always believe it is very important to actually learn about the psychology behind those things. Because if you don't understand a concept at its core, you're just learning fluff and you really don't know why actually the stuff you're learning works, right? So fun fact, the first time that I learned about these kind of ranges was during Baby Pips in 2018, where they were teaching us pretty much how to use the Fibonacci. And they said that that 50% level together with the 61.8, there are like the golden zone, the magical numbers. And whenever there was a support zone that aligns with a 50% or a 61.8%, then that is like determined as a very high probability trade. And back in the days, that was one of my favorite setups. With time, of course, there has been more content, there has been more insights into what actually that is, and I have turned from a Fibonacci trader to just a very simple premium and discount trader, just using the 50%, okay? And why is that? Well, the core of the concept is within answering the question of what is high and what is low, what is cheap and what is expensive, right? Because again, as traders, we always want to buy low and we always want to sell high, okay? And the market is constantly moving in between premium and discount ranges because it goes from expensive to cheap and from cheap to expensive. It is a constant cycle, and this is why you're constantly seeing in the markets up and down moves. The market will never move in a straight line, just going on for that high without pulling back, okay? It's always gonna get high, then it's gonna get low, and then from low it's gonna get high, and then it's gonna get low again, okay? That is pretty much the cycle of the market. And our aim as traders is to pretty much know what is cheap so we can buy at that zone, and what is expensive so we can then sell it. Once again, buy low, sell high, which is pretty much the name of the game. Now, every dealing range has a premium and discount. So what I mean by a dealing range, well, that is pretty much, imagine a very simple higher-low formation. If I just draw it, imagine a simple higher-low formation to a higher-high. So that is the current structure. That is your current range. Again, call it a dealing range, call it a valid range. I usually call it valid range, right? Because we have a very specific way to determine higher lows and lower highs so that we know exactly where that dealing range starts from. So every sort of such a range, it has a premium and a discount, okay? And within that premium and discount, we also have something very important that is called a equilibrium level. So that equilibrium price, that is exactly the 50% of that dealing range. And what I have found out is that this equilibrium price acts as a magnet for price. Because when price is in discount, it is going to be attracted to premium. And when it's in premium, it's going to be attracted to discount. Okay, and pretty much the equilibrium price is the threshold between those two zones. And as I told you, this is exactly why structure is being built. Well, not exactly, but this is just part of it, right? The market is going to push up. It's going to form a new dealing range. This is going to be your 50%. Okay, so that is your higher low to higher high. And then, of course, the market is going to go from, this is from premium. It will like to dip below discount. So it's going to come in, tap the 50%, and then anything below 50%, that is determined as discount. And then usually from here, around the 50% area, that is when the market is going to go once again to continue and make a new dealing range, a new 50%, a new premium, and a new discount. And that is how the cycle repeats, but we're going to look at the technicals in a little bit. Now, trading ranges exist on every time frame, from the monthly time frame to the 1 minute. And this is the fractal nature of the market. So you're going to have these PD ranges on every single time frame. And exactly because of that, you really have to systemize your PD ranges and have very specific time frames on which you actually draw them. Because if you draw your PD ranges on every single time frame available, you're going to have 100 PD ranges and you're not going to know which one to follow. And in this video, I'm going to tell you personally what I do so then you can steal it and you can utilize it for your own. Now, waiting for the market to get into P or D is going to increase your win rate automatically. And pretty much this is what I'm telling you. You can double your win rate by simply introducing this PD concept, because you're always going to be filtering out your trades. You're always going to be trading from the right position. Essentially, you're only going to short when the market is in premium, and you're only going to long when the market is in discount. And this concept by itself has really changed my game personally, since I really looked into it and I actually understood, okay, like it's not really 61.8, it's not like 786, it is just everything that goes below the 50%, right? Which is pretty much discount or premium, okay? So that is the psychology behind. I hope it makes sense. I hope you actually understand why these PD ranges work, okay? Because again, just to summarize, every dealing range, so every structural formation, every higher low to higher high or lower high to lower low, it has a dealing range and it has that equilibrium price. That is potentially maybe even institutions or even algorithms, they just have that price and the market is going to be pushed towards that price. So if we have that higher low to higher high, this, for example, let's say it's 1.12. So if the market is at 1.13 right now, it is going to potentially be pushed towards 1.12 to actually get into that middle ground, into that threshold, to dip below discount, and then of course from here it knows where the high is, which is potentially the next liquidity target. So with that being said, hopefully PD ranges make sense. Right now let's actually learn how to use, and I'm gonna be giving you some rules. So how do we actually use the PD range concept? Now, as I told you before, you really have to get clear on your time frames, and usually I personally draw them on 2 time frames. The first one is the macro time frame. That is pretty much your higher time frame. You know, I've published a lot of videos on that. Make sure to watch some of my market structure videos and on time frames as well. For me, I use the daily and the hourly time frame to draw macro time frame PD ranges. However, for simplicity purposes, make sure to pick only one. At least for starters, pick one, and I would suggest you pick the hourly time frame, because it's a very good balance between being like a higher time frame but also offering you the most recent sentiment of the market. So that is pretty much to define your macro time frame PD ranges, and those are going to be your most important PD ranges, because that is going to give you the high probability positioning of price. So positioning of price, very, very, very important, because with that you're only going to be selling from higher highs and lower highs in premium, and you're only going to be buying from lower lows or higher lows in discount. So just this concept alone is going to change your game. And again, that is your macro time frame. Now then, of course, what you also need is a middle time frame. So that, again, you have to choose for yourself. I would recommend going from the 15-minute all the way to the 1 hour. So again, which one is going to use? Personally, I use the 15-minute. Okay? And that is pretty much to define your middle time frame PD ranges. Okay? Why do we do this? Well, because when taking a trade or when framing a trade idea, we usually follow the middle time frame ranges, because our supply and demand zones will most likely be there as well. Because you know, your entry should always happen in PD of the middle time frame range. So again, that is right now getting into the complexity of the markets. You're going to be having a macro range that looks like this. So again, as I told you, you're going to be selling from higher highs in premium. So right now, imagine the market is here. So you want to be selling towards the 50%, okay? But just because you have this on the FOIH, you cannot just plot a sell right there. You have to go to your middle time frames, right? And then you're going to be needing a bearish leg right there on your 50-minute time frame. Your zone is going to be here, and that middle time frame is also going to have a PD range. Okay, and then of course your zones and your entries should always be above the 50% on your middle time frames, similar to the FOIH. Okay, but of course examples on that a little bit later. So I do not use PD on entry time frames like the 1 minute and the 5 minute, right? Because again, once you actually have your middle time frame zone, then you're going to drop to the lower time frame and you're once again going to be looking for an alignment. Okay, but again, the alignment there, it is also going to have a PD range, but then of course you're getting way too many PD ranges. And of course, if the market is in your respective zone on your middle time frame and is above or below discount depending on the trend, then you really do not need to draw PD on your entry time frames as well. Okay, you can of course use it, but as long as prices, as I said, in the PD of the middle time frame range, lower time frames, doesn't really matter. And one very important detail is to always take the most recent range. And for that, you really have to learn how to draw market structure properly. I see a mistake being done by a lot of traders. You're having like a lot of structure like this. And then you say, oh, well, this is my low and that is my high and that is my dealing range and this is the 50%. Well, you're missing all of these, right? That is most recent because every one of these ranges, it has a 50% and is a dealing range on its own. So make sure to always take the most recent ranges, okay, and not really look at any kind of swing structures like that. How do we draw the PD range tool? Simple Fibonacci. We need a Fib tool with just 1, 0.5, and -1 stats on the Fib. Make sure to keep it clear. This is personally how I use it. So there it is. Make sure to copy those stats and make sure to check out all of my tools, including the Fibonacci and everything else that I use on my TradingView tutorial. I'm going to leave a card or a link down in the description. Now, let's have a look at more technical stuff of the PD ranges. Now, let me talk to you about the cycles of the market. As I told you, the market moves in cycles. It goes from expensive to cheap, from expensive, and vice versa. But also another detail about the markets is that they have a fractal nature. So again, one expensive is going to be cheap of another time frame, or cheap on one time frame is going to be expensive on another time frame. And this is why you really have to have that understanding of all time frames and how they work together. So if I'm to give you an example, here is a 4-hourly time frame. So again, as I told you, we're going to be taking only the most recent ranges. So starting from this low to this high, the market pulls back. And again, a very important rule that I really want to make sure that you understand is that the market is not always supposed to be pulling back to equilibrium on your higher time frames. So I repeat, it is not supposed to be pulling back to your 50% always. However, what you always need is some sort of a pullback. Okay, and this is again, I'm gonna later mention in the details, you really have to learn the behavior of the pair you're trading. But usually the market is gonna make an uptrend on the FOH, then it's going to make a trend change to the downside, it's going to make a downtrend on the FOH, then it's gonna make a trend change to the upside, and it begins a new uptrend before it makes another trend change down, and it starts a new downtrend. And every single one of these ranges, it has a PD range on the FOH. However, do you see a pattern right there? There's a push, there's a pullback, and there is a push. Well, exactly. On the daily time frame, we have a bigger daily range. So on the daily time frame, this is again still the 4-hourly market structure in this diagram, but on the daily, that is a daily low, that is a daily high. That is a daily higher low. Where did that daily higher low formed? Below the 50% of the daily dealing range. Okay, and then where it goes for a new higher high on the daily, it has a new dealing range from a daily higher low to daily higher high. There is a new dealing range 50%. The market is going to be dipping below it and then most likely going to continue higher. Okay, so you see there were a lot of hourly ranges within that big daily range, and which just pretty much gives us this sort of cycles of the market. So there is one big cycle going on the daily, like this, but there are mini cycles on the FOH. So that is pretty much as a day trader, those are the cycles that you want to trade, the 4-hourly time frame. But you always have to be aware of the macro cycle of the market and what is actually going on the higher time frames. Okay, so just hopefully that explains things, because a lot of times the 4-hourly time frame is going up and up and up and up, and you're like, okay, the market is bullish, and then all of a sudden it reverses lower. Usually the question of why a reversal is happening, you're going to find on the higher time frame. So if we ever wonder, okay, why did the market make a trend change here on the FOH and started trending higher? Well, look at your daily, look at your weekly, because that is always going to contain the answer. Now, before we jump onto the charts to actually give you a systematic process on working with PD ranges, let me first of all give you some key insights and examples. Key insights. This is probably the most important part of the video because we're going to be getting more actionable right now. So first of all, you really have to determine your time frames. For me, I use the 4-hourly time frame for my macro higher time frame and the 15-minute time frame for my middle time frame. I suggest you start there. You can play with a 15-minute, you can make it the 30-minute, which is going to increase your probability a little bit because the 15-minute can be noisy, but at least have those two main time frames, higher time frame and middle time frame. Then learn your pair behavior. As I told you, the market is not always supposed to pull back to 50%. Some pairs love to pull back just 20%, while others love to pull back more than 70%. So study your pair, okay? The move that makes a trend change rarely gives a 50% pullback. So if I'm to actually illustrate this, so if the market has been going in a downtrend and there is a trend change, well, that first dealing range that makes the trend change right there is usually not going to give you a 50% pullback. And I want you to go and back to this one. It's usually going to give you like a 20 to 30% pullback. Then it's going to go form a new dealing range from this low to this high. And then usually the second push, that is what is then going to give you that 50% pullback. Okay, so that is just a little hack from my side, because I have found this through a lot of observations. The move that actually causes that first trend change, that first reversal, is usually not going to give a very big pullback. And usually when I see this, I really focus on actually getting the trade without really looking for that big pullback. Okay, so always pay attention to price positioning, because the best lower highs will happen in higher time frame premium, and the best higher lows will happen in higher time frame discount. Okay, and if the price is at a lower low or at a higher high, look for the market to pull back to equilibrium, which is pretty much going to mean that you're going to be taking counter trend trades. So add this price positioning onto your trading arsenal. If the market is not in discount to take a long trade, don't take a long, wait for a discount. If the market is not in premium to take a short trade, wait for it, because usually the market is going to be attracted towards these prices. Now, very important, equilibrium tap does not mean reversal. We are often going to see in the markets that the market is going to tap the 50% and then it's going to reverse. However, don't take this for granted. Don't take this as a fact and like something that must happen, because in the market, everything can happen. And usually in order for the equilibrium tap to cause a reversal in the market, you need to have some sort of liquidity taken and a middle time frame shift. So if I'm once again to try to illustrate this with my magical pen, we're having a bearish dealing range from this high to this low, and there is the 50%. So if the market taps the 50%, but there is just imbalance to the left, right there, well, there is no liquidity. But if there is a nice prominent high, maybe it was like a session high or like a very defined high, if the market goes above the 50% and takes out liquidity above a high, and then it gives you a middle time frame alignment with a brand new PD range right there, so that is your best trade. Okay, it's all about positioning. If the market is all the way down there, are you going to be taking a short? Well, most likely not, if it's not the first move that made the trend change. Usually you will be looking for the market to gravitate towards the 50%. So where is the market right now? It's in discount. What you're going to be doing is you're going to be looking for middle time frame ranges, drive the market towards the 50%, and then you simply look for an alignment down, so you can then start looking for the shorts. Okay, so again, keep that in mind. However, this is some next level that I can be doing more on liquidity. Let me know in the comments if you would like to know more about this. But the 50% does not mean reversal. You need to have liquidity to the left. And if you don't have liquidity, the market is going to go above the 50%. It's going to generate its own liquidity to take your stop losses a couple of times before it actually moves. So again, liquidity is another very important concept that, of course, I can speak more of. Let me know if you want to see this. Right now, some examples. Now, just to very quickly visualize what I mean by all of those PD ranges. So there is an example of macro PD ranges. That is the 4-hourly time frame. So once again, we start from this high to this low. There is the 50%. The market pushes way above the 50%. As I explained it just a little bit before, there was just pure imbalance. There was not really any highs or lows to be taken in order to act as liquidity. So the market generated its own liquidity here, went very deep inside premium, and then it just dropped. On this drop, we have a brand new dealing range. Why? Well, because we have a structure break right there. And then again, the market, what does the market do? It pulls back. It again almost taps the 50%. As I told you, the market is not always supposed to be tapping the 50%. Here we came very close. Then the market goes on. It creates another structure break. Once again, the market just pulls back a little bit. So depending on your pair behavior, you can see this pair only once pull back to 50%, but it's usually going to be attracted towards the 50%. And if you start seeing lower time frame shifts around these areas right there, definitely don't hesitate going short. Now here we have a brand new massive dealing range. There is a 50%, the market pulls back, rejects. pushes up again, rejects, and then what it comes in and does, it actually comes in and makes a hourly structure break. So this dealing range failed, and this is going to happen. However, you keep following the market. This is, according to me, the last valid higher low that caused the break. It was broken right there, and pretty much even if you didn't take this, that is the break here as well. If you wish to trade like us more swing breaks of structures, high to low, the first trend change is not going to pull back to the 50%. So there is a slight pullback, broke lower, and then again we shift again. So we have from low to high, 50% taps, continues from low to high, 50% dips, continues from low to high, 50% taps, continues. So what is happening right there is, once again, we have this cycle. So we're having like this overall cycle right there. And right now the market is starting to reverse a little bit higher. Why? Well, because most likely there is a bigger cycle going on the daily. Okay, so always make sure to keep in mind at your higher time frame. So if you're using for the 40 time frame as your higher time frame, make sure to always monitor the daily, because the daily is also going to give you some clues about where the 4-hourly could potentially reverse. And there is an example of the middle time frame ranges. So once again, the 4-hourly high was up there, the 4-hourly low was down there. In order to start trading the pullback, you first have to wait for the middle time frame to give you a bullish trend change. So there is a 30-minute trend change that formed a new PD range. So there is 30-minute low, 30-minute high, the market immediately dips below the 50%, makes a hard high. New 30-minute low, new 30-minute high, the market comes in, taps the 50%, runs for a new high. Here, we aligned bearish for a second between this low, that is the high that caused the break of the low, 50%, lower low, then this is Asia, it chopped around. We have a new bullish 30-minute alignment, pulls back below 50, pushes, pull back, pushes, pull back, pushes once again before it actually decides to flush. Why did we have all of these? Because there was just pure imbalance to the left. There is nothing that the market could take to fuel a move down. So the market had to actually generate its own liquidity and make a little bit of an uptrend to the upside in this case. Okay, but always keep in mind that every middle time frame is going to have its own PD range. And for me, it is a must. It is a must that my entry is taken either P or D on the middle time frame. I do not take trades if the market, say the market was right here and didn't really tap the 50%. I am not taking a long here. I'm only taking a long when the market taps the 50%, and preferably I want for my long to be taken below the 50%, because then I have a lot of space to be targeting the higher high, which is going to give me a good risk to reward. Okay, so hopefully this PD range concept makes sense. Right now, let's jump on the charts and actually show you how I approach the charts every single day so that you're actually prepared when you go on your charts. Usually at the beginning of each day, I'm going to start by looking at the daily time frame. So here we are on a GBP USD, very fresh price action. What we're having right there is a daily structure break. Okay, so what is the daily dealing range? Is between this low to this high. Where is the market right now? Well, it's below the 50% on the daily. So what we could potentially be expecting in terms of the daily is the market to push up. Okay. However, as I keep telling you, that is not always the cases. Okay, so we go back to the 40 time frame. And what are we having on the 40 time frame? Again, you have to track structure. According to me, this is where the 40 trend change happened very recently. So we had a brand new dealing range from high to low. The market pulled back above the 50%, and then it chopped around for a very long time, but it ended up breaking lower. So we have a brand new 40 structure break. And then the most recent dealing range was from this high to this low. Again, what is the high that caused the break of the low? Again, it's not this, it's not this, it's not this, it's not the high. This is the last buy to sell that caused the break. Now, what did the market do pretty much yesterday? It went up, it pulled back above the 50%, and it tapped into a supply zone. Okay, so if I was trading during yesterday, I will be looking to short above the 50%. But if I'm just looking at the market today, well, you have to also track what has happened already. The market pulled back above the 50%, and right now it's making its way towards making a brand new lower low. So again, my bias is potentially going to be shorts, and I'm going to be looking for a brand new 15-minute dealing range to potentially take the market into the lows. So currently, the most recent dealing range is this high to this low. There is the 50%. And there is my potentially supply zone. So what I will be looking for right now, if I'm just trading on that day, for the market to go above the 50% and then to give me a lower time frame alignment and then to take a short towards that 4-hourly lower low. You see how fast we actually build a trade idea here? Let's try again. Let's go to a random pair like Euro JPY, because JPYs are usually very tricky. Now, we're going to start with a daily time frame. And you can see the daily time frame is an absolute massacre, but very recently we had a very it's not the best break, but we have a break. So the current daily dealing range is from this low to this high, and you can see this candle kind of took out the high, but then it's also within the 50%, so not very clear, but that is our daily range. And then yeah, you can actually see that this is exactly where it formed here, so pretty much the daily 50% is here. But then it dropped on the 4-hourly time frame, which is once again stick to one time frame. Doing two gets a little bit confusing. What did the 4-hourly time frame do very recently? Well, first of all, if I actually just delete the daily time frame, we had a 4-hourly trend change right there. Then the market went on and made a 4-hourly trend change up. So that was the dealing range at that time. The market pulled back above the 50%. It tried to push, but it failed, and then it caused the trend change. And then here you see we have a push. So what is the dealing range? It's from this low to this high. The market pulled back below the 50%. So this is where we look for longs on the middle time frame. So what do we target? Is we target the higher high. So right now this is the last structure break. So again, I'm not going to be taking my dealing range like this or like that. Where is the most recent valid range? It's from this low to this high. Fresh, right? Also, some other confluences you can draw is you can draw an imbalance. So where is the market right now? Well, it's above the 50%. We haven't yet dipped below the 50%. But as I told you, the market is not always supposed to be dipping below the 50%. But of course, I would expect for it to go down there. So then I drop to my middle time frame. And of course, I'm going to have two outcomes of that day. If the market starts showing me bullishness, because I'm bullish on the 4-hourly time frame, I'm going to take a long trade. But if the market shows me bearishness, I'm definitely going to take the short, target the 50% and target the imbalance. And then from there, I'm going to be looking for a bullish alignment to start going higher. And as you can see, currently, the market is still trading like this is the last here, 15-minute break. And technically, this is the 15-minute demand zone right there. So again, be careful not to get messed up in internal structures like this, because all of this is internal. So on that day, this pair doesn't look very good. Okay, let's do one more. Aussie USD, for example. I know this one is not looking very good, but let's try harder. Now on the daily time frame, again, you just have to track the time frames a little bit. There is a daily break of structure right there. That was the most recent daily dealing range. The market pulled back above the 50%, and then it's going on the way down to be making a new daily break, which it still hasn't. Strange that it stopped just at the daily low to pull back a little bit, maybe to grab some liquidity. And right now it looks like it's actually headed to that daily lower low. So you can see your highest time frame that you can use, which could be the daily, is actually bearish. But then the 4-hourly time frame, you can see what the 4-hourly time frame does exactly in the examples I showed you. It goes in cycles. Cycles, then a bearish, then a little bit of bullish, then right now bearish, right? It just keeps going in cycles. But again, you have to know what is the last one. So from here, we have a 4-hourly break of structure. We were expecting for the market to take out this low, but guess what? It aligned bullish. And what did I tell you about the first trend change? It usually does not pull back to 50%. So that is the low, that is the high. The market just gave us like a maybe 30% pullback. It broke and made a new high. So there is your brand new dealing range from this low to this high, 50%, higher high. All right, so then you have a brand new dealing range once again. There it is, but then the market just blasted through it. So currently, the market made a brand new trend change to the downside right there. And the dealing range is from this high to this low. So what did the market do? It pulled back above the 50% and it took a little bit of liquidity above this high. Okay, so again, depending on the day you're trading at, so if I was trading on Thursday, I would be looking for longs down there, because I will be looking for the market to push me up above the 50%. Now, as it pushed above the 50% and as it's traveling to the downside, well, of course, my target is going to be the 4-hourly low. And then, of course, I know from my daily analysis that the daily low is also most likely going to be broken. So then, of course, I jump to my lower time frames and I focus on shorts. How do I get into a short trade? Well, of course, you have to follow the most recent ranges. And for example, there we had a breakdown here, we had a break up there, then the dealing range was from this low to this high, but we're not interested in a long. We look for shorts. So there is the market making a trend change to the downside. What was the high that caused this trend change? It was that high to this low. The market pulls back above the 50%. It taps inside your supply zone, and right now it's making its way down. All right, so you can see how we frame it from the daily to the forex, then to the 50-minute, and to trade with our macro time frame bias in mind. Okay, so hopefully by now this makes sense, and it has introduced a very nice systemized process. Again, follow the time frame. What is the market doing? First of all, you really have to master structure, because if you don't know how to mark up structure, then of course you're going to be marking ranges like this, which is again not incorrect, but you really have to get systematic, because again, if you draw this big range, you're missing stuff like this. You're missing this lower low to this lower high to this lower low to this lower high to this lower low, and then of course you have a reversal. But again, that was potentially a daily pullback, and right now we're initiating once again the daily push. So always think in terms of the bigger picture, but also zoom in to have a look at the current sentiment and the current middle time frame picture. So that is the chart tutorial. If you have any questions, let me know in the comments, and I'm gonna be making a follow-up video if you need it. Alright traders, I really hope you loved this educational video. Make sure to hit the like button if you did, and I also have a question for you. What is missing in your trading, and what would you like to see from the channel? Do you have any content ideas, anything that is going to help you become a better trader? Write a comment down below. What would you like to see? Give me some content ideas so that I can start working on them as soon as possible. Now it's time for practice, because as every single concept, it takes time and it takes chart work to actually go on the charts and see how it works live. So good luck studying the PD ranges, and if you have any questions, don't hesitate to contact me, and talk to you on the next video.